Hello, folks. Welcome to the Two Stewards Show. And your hosts are Mark and
Brent.
Hello, Brent.
And this is not financial advice.
Okay,
This is entertainment.
Okay, yes, there you go. I mean, if we fail at entertaining, then there's really no point, is there?
That's true. I didn't think of that.
So, I don't know. Information as well. We'll give you some information. Not advice, but information.
On that note, Bitcoin is up. Hey?
Yes. Many. It's up a lot.
Yeah. So,
but that's not the...
we're just reiterating, this is not financial advice.
No. And that's also not the... that's a side benefit of investing in a new monetary system. But yeah, all-time highs. Cool. But yeah, why don't we do a little bit of market update, current events, that kind of thing.
Yeah.
I know one thing I wanted to talk about was this... excuse me, sort of Hamilton area group of investors, and
that hit the news recently.
Yeah, and it's been in the news for a little while now. It's not brand new, but maybe not everybody's heard of it. But it's kind of instructive to look at what happened, and I don't know, avoid doing that. I guess.
Well, okay, just maybe to give a bit of perspective, I think one thing to think about is real estate. Are there even any opportunities left, like, out there? And maybe when rates go up, people are going, oh, I can't afford it, and there's just no opportunities like real estate. And then when you hear something like, oh, this is really good investment, it's actually too good to be true, and then and then it all goes sideways. You're like, oh.
Yeah. Well, so are there opportunities left, Brent?
I think there is. And this kind of gets into like short-term versus long-term thinking again, right? Because if you're out there trying to make a quick buck, and I think that leads into the story that we're going to talk about, is the temptation to try and get massive gains quickly leads people to do things that aren't quite the wisest. Might be shady, I don't know, but I'm not going to point any fingers, but it looks...
Are you, like, at me?
I don't know if you put any money in on this, but...
No, fortunately. No? Yeah, it's a good point, right? Real estate is a get-rich-slow scheme.
Yeah.
Essentially.
So when you see something trying to be advertised as get-rich-quick...
Yeah.
Just be on alert.
Yeah, and I think that applies to, I don't know, every area of life, right?
Yeah.
Right? I don't know. I think so anyways. But yeah, it's been...
I don't know. I was just trying in my brain to compare it to every area of my life, but I can't think that fast.
Well, no. During COVID, you saw like a huge increase in a lot of these types of ideas, right? I mean, get rich quick has always been around.
Yeah.
Right? But especially during COVID, that seemed to really accelerate.
Well, yeah, because anybody who was doing anything in real estate looked like a hero, right?
Yeah.
So if you had real estate, you were successful.
You just had to throw a dart at a board.
As long as you own something, right? It's went up. So when the rates come back down...
Yeah. Well, but I'm also thinking
back
of
up.
The stock market, right?
Yeah.
Lots of FOMO and lots of these stories of huge gains and then huge losses, right?
So is that what Bitcoin is right now?
No, it's a different
different
story. I mean, it's still volatile.
That's what they say. It's different, eh? Bitcoin, this time it's different.
I don't know. I think most hardcore or experienced Bitcoiners are not like, they love the gains, but they're in it for the long term.
Yeah, for a slightly different reason.
Yeah. And so kind of same ideal with real estate, right? Like, when you have gains like we've seen, like that's great, but it's probably not sustainable, and it may come back down to sort of regular growth rates, which we've sort of seen. Although, so you just put an offer on a place, right?
Yeah.
In
that's quite
Hamilton,
we try to do a lot of offers.
Yes, but the most recent one.
Yeah, the last couple, actually, there's been multiple offers coming back, and what is it, like 10, 15, 20 offers? I forget. The one had like 27 offers. I mean, some of these properties are just massively underpriced, right? So, and then you get a lot of people offering, and they're offering a little bit more
Incrementally
than
more,
Yeah,
yeah.
they're offering a little bit more than what it's priced at, but it's really valued a lot higher, right? So, but that said, there is definitely a lot of people out there still looking to own real estate. For various reasons, but the properties that we're looking at are primarily investment opportunities, right? So I would think a lot of the people who are offering on them are also investor mindset.
Yeah, and I think with people are kind of looking at interest rates and making predictions in their own mind anyways as to what's going to happen. And I mean, the consensus seems to be that we're not going to go up.
Yeah.
At least, right? People may argue about, well, there's going to be 2 rate cuts this year. There's going to be 4, and there's a lot of very good reasons for all that. And it's really hard to know exactly. I mean, well, you don't know, right? There's so many things that could happen, right? I mean, we had a pretty good idea.
What's your guess, Mark? Live on the podcast.
Oh, here we go. Are we okay? You're putting me to the test here.
Yeah.
I mean, there has to be a disclaimer, right? Unless something ridiculous
Entertainment
happens.
value only.
Yes.
What's your guess? No, okay.
No, I could see probably a couple of rate cuts
Yeah.
this year. Nothing huge. And but I mean, if things change, we could also see
gotta get
rate
into this.
increases, right? No, because I think everybody's like, no, we're at the peak, and it's just down from here. For, I mean, we were looking at the Congressional Budget Office, their predictions.
We're getting into everything all at once.
No, just very quick. We'll get into it later.
Yeah, okay.
But I mean, their predictions. They're looking at a Fed funds rate, so like sort of like prime rate or whatever you want to, or that not prime rate, but the official government lending rate at 5% now on shorter term debt, and they're looking at that to decrease to 2.9% in over 10 years, right? So it's kind of the narrative is that we've sort of reached the peak of pricing of interest rates, and they're going to slowly decline from here on out.
Yeah.
Right? And that's assuming nothing massive happens in the interim. But like in 10 years, what are the chances of something like, it seems like big things,
Some sort of recession.
big events happen, much more rapidly.
Much more
and there's
frequent
so
and
much
much more violent.
data to go through, like employment reports. We were talking about business insolvencies, all this kind of stuff you got to try to put together. And if you look at the experts, right, they don't agree either.
Yeah, even you and me.
Yeah. The day we're considered experts, Brent.
I don't know about that. Okay.
But anyways, my prediction is probably a couple of cuts this year, if nothing major changes.
Yeah, it's a two-edged sword, right? If the rates stay up, then the prices will stay suppressed. But if the rates come down, and when the prices stay suppressed, we can pick up properties at a better price. But if the rates go back down, then money gets cheaper, your payments get cheaper, but everyone starts bidding more on houses because of that. And the property that you might own already would be doing better. Yeah. Because I know for a lot of investors feeling the pinch, right? But
yeah, and I mean, my thesis has been for years that interest rates can't really go up meaningfully for a long time. Right. And they're up more than I thought they would be. So I guess, I'll eat that as being
well, let's talk
wrong.
about that. Because all this leads back to that first story you mentioned, right? Because if rates go up, your cost of borrowing goes up, and eventually pain happens.
Yeah, and so my thesis was that interest rates can't go up for a long time, very far, because that increases payments on the debt, and that's it's just not sustainable. And surely politicians must see that. But I mean, there's other things at play, right? Inflation. I mean, I'm thinking back to the 40s. Not that I was alive then, Brent.
Yeah.
Okay. But where we saw inflation run really hot, and rates went up too, but inflation ran quite hot for a long time, and that ate away at the debt. Yeah. Right? But politicians don't have the will right now, I think, to let inflation run really hot. Yeah. Well, this guy can't take a hint. Leave a message. It can't, it can't, because they're not going to get reelected. Yeah. I think is what it boils down to. When people are feeling the pain, they're going to take it out on the current government, whoever that is. And so they're very worried about inflation being high. So they want to keep rates up to deal with that. But then then you get into fiscal dominance. I don't know if we want to get into that.
Oh, man.
But where it's a self-fulfilling prophecy when rates are high that actually contributes to inflation because of the massive debt payments. Right?
So you are an expert, actually.
No. I just hear some different terms on Twitter and kind of throw them all together. Okay. But okay, let's get back to the first story we wanted to talk about. So, Hamilton area group of investors and their mortgage broker. So, I mean, this is all public record. So I don't think we're defaming anybody. But you've got
just reading from the CBC.
Yeah, so you got Robbie Clark, who was a child actor in Canada. I can't remember what he was in, but something. And then a couple of other investors, Dylan Suter and Ryan Maloney, Ariba Butt, who, they built up this big sort of empire.
Sort of empire. It's like hundreds of properties.
Well, I think it was, up to 800 at one point.
Yeah.
Right, and they've divested some of those properties. So the whole game for them was buy in secondary or maybe tertiary markets. So like Sault Ste. Marie, Timmins,
Sudbury,
Kirkland Lake, all these areas, and then do the real estate thing. Right, you find distressed properties.
Yeah,
you fix them up. Right, so you value add, you stabilize. You get more rent, and you fill them with tenants, and then you can refinance at some point as well, right? And so that, again, when values are going up like crazy, that's easy to do.
Yeah, because you're buying it.
It should have been easy.
Well, you're buying it, you're renovating it, and then by the time you're done the renovations, everything's ready. The values increase significantly. Like maybe a year's gone by, and the values gone up 20%.
Yeah, well,
we were seeing 20%. In a month.
Yeah, exactly. Point, right? Well, that's the BRRRR strategy, right?
Yeah.
BRRRR, B-R-R-R-R-R-R.
Yeah.
Buy, renovate, rent, refinance, repeat.
Yeah. Run for your life.
No, but I mean, that's a sound real estate strategy, right?
Yeah.
You find a distressed property. If you have a little bit of expertise, you can fix it up for not a ton of money.
Well, the thing is, all these strategies, they work, but they have to be employed properly and with patience over time, and
and the right house. You can't just buy any house and fix it up, because it could be you could lose. It could be a money pit.
Yeah.
And you actually have to do the renovations.
So what do these guys do?
Well, so part of the issue here was that for a time, even before COVID, it was really starting to ramp up, but especially during COVID, that if you did that model, you would make money, even if you bought the wrong house, just because, like you said, prices were going up so ridiculously.
So you can kind of loosen up your systems. You can just, you might not be as particular about which property you select, which area. You might be, just hire any contractor, that sort of thing. Is anything works?
Yeah, because the price was, even if you didn't make money on the renos, the price, just looking at comparables, would go up.
Yeah.
So, I think that was part of it. But now, as the information is coming out, there's more stuff they weren't even doing the renos on a lot of these homes, right? So the big question is, where did the money go that was going in? So they had a group of companies, right? They had one company would buy the houses. They also had a contractor. This is a great model.
Yeah.
Right? If you have one company to buy it, and then you have another company that you own that actually does the renos, cool. And then you have another company that does the property management, right? I've thought about sort of a similar model, but on a much, much smaller scale. But it makes sense, because you're feeding each company, but they should all be profitable.
Yeah.
Right? And you have to actually do the renos. So what was happening, which investors didn't know, is that the city was starting to hit these guys with fines for having these dilapidated properties, right? They would buy this house that was in bad shape. They would have it for a year and do nothing, and it would get into worse shape, right? You got weeds in the front yards. If you got water getting in somewhere, that's only going to make things worse. And the cities were starting to get fed up. They're starting to get fines. And I don't know, you got to really be screwing up to get fined by the city, I think. Right? Because it's not they just look at it and hand you a fine.
No, they give you opportunity to kind of
fix
the situation, do some work.
Yeah, we've had issues with, I think, in one particular property with the tenants being messy and stuff, and we had to go straighten things out. But you didn't get a fine right away. City's going to be like, hey, we get complaints.
Yeah, we've had that too. But yeah,
yeah, I know. There's always a story behind that, isn't there?
Oh, we've had a tenant idling in the driveway, but it was really loud because his truck's really loud. But 4 a.m, right? So yeah, by law. But that's not so much about the property, more about the tenants.
Yeah. So anyways, this group of companies, they started having some issues making payments, paying the mortgage and stuff. So they sold a bunch of properties, 170-ish, I guess, and to raise some capital and get out of some of these obligations. But clearly they didn't sell all the worst properties. They were probably selling the best ones because that's what people would want to buy, right?
Yeah. Well, yeah. So if people want to kind of dig up this story, if they haven't seen it, it's CBC has an article. What is it? 3 landlords among the largest real estate holders in Ontario owe $144 million under bankruptcy protection documents. So a small group of landlords who owns hundreds of rental properties across the province have run out of money, owe over $144 million in unpaid loans, and face dozens of lawsuits from creditors, according to documents filed with the Ontario Superior Court of Justice. So that just gives you an idea of the scale of what we're talking about. If you own hundreds of homes, they owe over $144 million in unpaid loans. That's a significant amount, right?
Yeah. Well, okay.
So how do you get to this point where you have that much debt and you can't pay it? And because their loan structure was interesting, right?
Well, we'll get into that. Yeah. But so a couple I'm thinking of Robert Kiyosaki, for example.
Yeah.
He owns tons of property and a lot of single family homes, but as far as I know, he's making all the payments, right?
Yeah.
But he'll talk about that often about, he owes $1 billion or whatever.
So having a ton of debt is not necessarily
but you have
break you.
No, you got to manage it properly, right? And so part of the story is if you look at these guys, well, you can't now, but previously, if you would look at their Instagram feeds, right? There's a common theme. They're living it up, right? They're lavish lifestyles and, whether that was what they were doing all the time or that was just the impression they're giving, either way, it seems like there's a lot of money going to lifestyle.
Yeah.
Which, I mean,
personal.
Yeah. If you can do that, fine. But, there has to be the backing to fund that.
Yeah, where's the money coming from?
Well, and that's the question, right? Where is all the money?
Yeah.
And it seems like the money's not there. And where did it go? So that's part one of the story, right? So these guys are now, I don't know, they're in restructuring, this whole group of companies, right? And there's, I think KSV Restructuring is the company that is doing this. So this information is available on the internet. You can read through and what was it? Okay. So the structure we should look at. So
but you're not super surprised about this sort of story popping up after having interest rates just spike like they have for the last, year and a bit. With such a really sudden increase and jumping that high, and these guys are in debt, and they had a model that worked when rates were low. Yeah. Right? A lot changes.
Well, yeah, even doing the stress tests, I mean, the rates are now higher than what the stress tests were.
Yeah.
So if they qualified under the old rates and let's add 2%,
Yeah.
Well, rates went up more than that. So, and I think that is that's the story here, right? If rates weren't high.
That's the lesson that we can kind of take.
Yeah, that's a big lesson, right? You got to really prepare for the worst case scenario.
Yeah.
And did anybody? I don't know, because we talked about business insolvencies are up in Canada quite a bit.
Yeah.
And it's not just, I thought, okay, maybe that's small companies or whatever, but no, it seems like it's big companies.
Yeah, bigger and bigger companies are filing for bankruptcy. And then that's hitting trends like we haven't seen since the 80s.
Yeah.
So.
Yeah, and I mean, some people will look at this and say, well, these are zombie corporations that should have failed a long time ago, but didn't because interest rates were low. So, I mean, that's one take. I don't know if that's true in all these cases, but that is, I have heard people say this, right? It's easy to, If interest rates are low, then you can be a little sloppier with your business practices or your
it just keeps
the debt
making me
that you
think
get.
about like business insolvencies and like this real estate group and stuff like that. It makes me think of, okay, well, if money's cheap and money's easy to come by, you don't need to deal with reality. You don't need to make a successful business. You don't have to run a tight ship. We don't have to make a real estate property work like the numbers work, right? Because money's cheap and money's easy. So if you think of through the eyes of the government or the central banks being able to create money out of nothing, they're even on another level, and they never have to be held to account, right? It's the same kind of thing. Like they can just print money and do things with it. And never have this, like never file for bankruptcy, right? Like imagine if the government's like all of a sudden, hey guys, interest rates went way up. We got to file for bankruptcy or lay some people off. Like they never have that reality check, right? This reality check right now for the last year is finally kicking in, and people are going, okay, well, if you're a zombie corp, like you said, or some sort of business that's not actually making money, well, yeah, reality is, you got to pull up your socks or you're out of here.
But it does happen to countries, right?
Yeah,
We've talked about that. There's numerous examples of countries. Maybe I should have had a coffee. Where this is, and we've talked about this in previous podcasts, right? Lots of examples, right? The difference for the United States, which is the one we normally go back to, is that like this is actually the reserve currency of the world.
Yeah, I think the difference there is that they are in a little bit more control, and they can kick the can a lot further. Yeah, right. Like a company. Hey, you were gonna get.
I got you now.
Yeah, a company who's doing this, or this real estate company, right? They can't control the interest rate, and they can only control their business, right?
Yeah.
So if it doesn't work, it doesn't work. But a country, they can kick the can further and further and further by just manipulating things, right?
Yeah, but that depends, right? If you're subordinate to one of the bigger currencies, especially the U.S. dollar or the pound or the euro.
The U.S. dollar.
What's that?
I mean the U.S. dollar.
Oh, okay. Yeah, they can kick that can a lot further than most other countries can. But
eventually they get a sore foot, though.
Well, the can empties out, so it gets later and later.
Okay.
But, okay, so let's get back to these.
We did say off the top, it's not financial advice. It is entertainment.
Yeah. Hopefully it's entertaining.
Okay.
So, yeah, anyways, what did we say? $144 million in outstanding loans that they're having trouble paying.
So they would buy a house, get a mortgage on it, but the bank usually lends 80% loan to value on the house, right?
Because the bank is like, hey, we don't want you to get in trouble. So what do they do next? And we don't want to let you get in trouble by borrowing too much. Yeah. So we talk about leverage all the time, right? The bank
sets a risk level, right?
Yeah.
They're willing to risk their money on this venture up to 80% of the value of the house. Because if the market goes down a bit and they can't pay the loans or whatever, they're going to take that asset, sell it, get the 80% like that they lent them back.
Exactly.
Okay, so that's their risk tolerance.
Yes. Yeah, so the interesting common thread in this is the mortgage broker. So this mortgage broker did almost all of the lending for these guys. So, okay, that's interesting. Like, okay, if you got a good company and good risk profile, and like we had looked at this probably a couple of years ago at maybe investing or doing some private lending.
When you say we, like
my wife and I, sorry, not you and me.
Yeah.
And
it's like, I didn't even know you 2 years.
We didn't. And we just got an email the other day actually from them saying, hey, you guys still interested in investing? Like, nah, I don't think so.
You sent back the CBC article?
I should have.
But you need some money.
So on one hand, you've got this company that, initially nobody understood this. They had a good track record for years, right? As they were building up this portfolio. It seemed like they're doing money, paying their debts and so forth. But okay, that looks good. This mortgage broker had been working with them, had clients who had dealt with them for years, and were making decent money. So
there's a lot of trust.
There's a lot of trust. But now we're looking at they would get sometimes a first mortgage for up to 100% of the value of the home.
And that kind of boggles your mind because...
A little bit. Like, you don't get that anywhere, right?
Yeah.
Like why the whole idea of, risk management and stuff. But, the idea was like, no, these guys are good. I think that was kind of the sales pitch. Like they're good. They know what they're doing. They've got hundreds of homes and they're doing this thing and they're making money. So that's fine. Okay. So they would find a distressed home in Sault Ste. Marie. And let's say it was $100,000. So they would raise money, get a mortgage with like private lending. This is all private lending, right? Individuals going through this mortgage broker. So they would get the loan for $100,000. Well, now they got to fix it up.
Yeah.
So typically if you're a flipper in Canada anyways, and I don't mean like the dolphin flipper, show in the 80s, or 70s.
That's going back a while for you.
A little while. Right. But typically you get cash, right? Because you're going to get a mortgage for probably 80%, let's say, if the bank allows you.
Not 100%.
Not 100%.
No.
So you got that 20% down payment, and then you need funds to do the reno. And you may find private lenders to help you out, your uncle or whoever, right?
Yeah.
But typically...
there's a super high rate attached to that, or a lender's fee.
Yeah, exactly. So you're incentivized to like get it done and pay it back quickly.
And there's usually a time limit too. Like they don't want to lend past a year or 2 years.
Yeah. And you can do like a bricks and mortar mortgage as well in Canada, right? But that's typically a little more restrictive. There's milestones, and they're not giving you all that money at once, right? You'll get X amount for...
Once you've completed this stage of the renovation.
Well, you've got to complete sections of the renos, which means you're putting your own money in.
Yeah.
They send a guy, he looks, he's like, yep, you're good, we'll release this money, and then you use that to fund the next stage.
So what were these guys doing then?
So they're getting 100% mortgage up front. Then they would get a second mortgage.
So they put $0 in.
$0 in.
Yeah.
Oh, okay, that raises an eyebrow. Then they would get a second mortgage and the second mortgages were a lot fewer.
And that raises a second eyebrow, and now you got both your eyebrows raised.
Yeah, because like, wow. Well, so now you have lending that is in excess of the value of the home.
Yeah, quite a bit too.
Yeah, and so, the idea is, well, okay, that's fine, but this is going to be worth so much more once we're done, so all that money will get paid back. We'll have a new mortgage, and it'll be wonderful.
Yeah.
Okay, fine. Then, what I should say is a lot of these second mortgages apparently were blanket second mortgages. And so, so there's a lot of things in this little saga that like I had never heard of.
Yeah.
I didn't know. And I'm like, well, you learn something about real estate all the time.
Yeah.
But then I also learned, reading articles and listening to people and talking to people that like, no, this stuff was not normal. You would never have heard of that because they just made this stuff up.
Yeah.
This doesn't happen. Any other mortgage broker, any other lender wouldn't do this.
Yeah.
Like a blanket loan for second mortgages.
So when you say blanket loan, you mean one loan across multiple properties?
Yeah, so you're going to lend to this company, but it's not going on a specific property. It's going on
a bunch
their
of
portfolio.
Yeah.
Like, just trust us. We got the money. We're going to use it for stuff.
Yeah.
And we'll pay it back.
To specify, like a second mortgage. So first mortgage is you, like you're the first in line. If something goes wrong, you're first in line to the asset and you get your money back.
Well, or if something happens, you get the asset.
Yeah.
Because you're the owner.
Yeah. But the second position mortgage is higher risk because you get what's left over after the first guy gets his money back.
That's right. That first mortgage has to be completely satisfied.
So if you got the first mortgage at 100% of the value, then the second position guys got...
Yeah, you're subordinate to that first position.
Yeah.
So, okay, that doesn't sound very good at all, right? So what can we do? Let's add another layer.
Okay.
So, I'm just looking at the restructuring thing here. So first mortgage loans, there's 390, principal amount of 81 million, give or take. Second mortgage loans, there's 121, these blanket loans for 8.6 million. So not a huge amount. Okay. Interesting. Then they issued promissory notes. And so this is one of the things where I'm like,
I give those out all the time.
Yeah, I try it. It doesn't work. Like, I know what promissory notes are, right?
Yeah.
Like, there's a pinky swear, like, I'm going to pay you back. But it's not secured by anything. But I never had heard of this in the context of real estate.
Right.
Like, that exists. Okay. And like, yeah, maybe with like a trusted family member or something.
Family, someone.
Okay. I can understand that. It's still high risk. I wouldn't advise it.
Yeah.
Have a contract, have some sort of recourse.
It's basically a gift, right?
Yeah.
If you're the one giving a promissory note, like you're basically just assume it's a gift.
Yeah.
That would be my
that has been my attitude. If you're going to lend money to someone, like unsecured,
what are
whatever,
what are the rates?
just consider that it's a gift and you're not going to get that back. And if you do get it back, that's a bonus.
Surprise. Yeah.
Yeah. So the promissory note, that was just like, hey, look, these guys are doing really cool stuff. They need some additional funding to finish these properties.
Yeah.
I don't even think these promissory notes were like, some of them would be on specific properties. I think some of them were blanket, and it was a much higher rate. Now,
so for the guy lending the money, he's getting 12, 15%. That's great.
Yeah, I guess.
Like that, it's appealing.
So yeah, 12 to 15% on a promissory note, I think is kind of appalling.
Yeah.
Right? Like, yeah, it's good rate of return, especially when interest rates are at 1%. It's an
attractive rate of return.
Sure, but there's other private lenders that were doing like second mortgages or just first mortgages at that same rate.
Yeah.
Right? So this is, you think of people with either bad credit.
The risk-adjusted return.
Yeah, exactly. So they're doing promissory notes, an unsecured loan at this amount. Like,
and the article says we're talking about like 54 million.
54 million. So the what was the first mortgages? 81 million worth of mortgages, and then 54 million in promissory notes. So like, just looking at that doesn't seem
54 million in gifts.
Like that's 2/3 of the value of the mortgage. So you could have a property with $100,000 first mortgage, and then it looks like maybe another $4,000 of second mortgage. I'm doing very rough, or no, maybe $6,000 a second mortgage, and then like another 30, 40 grand of promissory note on top of that. So you've got what did I say? Like $140,000 on the $100,000 property.
Yeah.
So even if you fixed it up and refinanced or sold it, you would have to sell it, because unless you refinanced at 100%, which maybe they did, but if you're doing at 80%, that the math doesn't work. You're not getting all that money back out. Yeah. And that's the whole idea with the BRRRR, is that you go in, you do some stuff, and you either sell it or refinance, but you get all your initial money back out. Yeah, so you have $0 in that property, or at least a good amount. So you're very little in that property, and that works. So like, just looking at these numbers, not sustainable. So but individual investors aren't looking at the overall performance of this, right? They're looking at a house.
Yeah.
And so to further complicate matters, one of the companies that was involved in this, the mortgage broker's son, apparently, son and daughter-in-law were part owners of this company. I don't think that was ever disclosed either. So, yeah, you had people who were clients of this mortgage broker who was reputable.
Yeah.
As far as I knew, anyways. And had been in business for a long time. And people who trusted their mortgage broker. I trust my mortgage broker. Yeah. We talked about this before. Like, I don't know all the ins and the outs. I just give her a big paper or a plastic bag full of receipts and be like, here, it's not that bad. But essentially, like, here's all my statements. Here's all the information. Like, see what you can do for me. Because you're the expert. I'm not the expert. And whatever you tell me, I trust you.
Yeah.
And she hasn't let me down. So
she hasn't recommended any promissory notes?
No. And if I'm trying to do something dumb, she'll just tell me, like, no, it's not going to work, or don't even go down that road. Like, okay, thank you. Thanks, Mom.
Yeah. Yeah.
But that's what you want, right? So other mortgage brokers are like looking at this going like, what? Yeah. It's crazy. And it's always easy to like look back on something and like point fingers when somebody's failed. I don't necessarily like to do that. But in this case, this was pretty egregious, right? Just the amount of debt. And then, I don't know. People trust, right? They would do a promissory note. They would get their money back. And these are typically like a 6-month term or something, right? just to like fund that reno, get it flipped, and get out.
Yeah. So I think the lesson, like you say, we don't want to throw people under the bus not knowing everything, right? But
it's all pretty public now.
Yeah, but at the same time, like, you know, I think there's a heart position on this too, right? For us as Christians looking at something, like the temptation to do something for a quick gain or even short term, like if you're making 15% on a private thing for a couple months and like, you know, that looks attractive and you want to do it. Understand the risk and understand what you're doing. And then if you're on the other side and you're trying to raise money, right? Like there's some ethics there around, maybe not having investors who are giving you money being fully informed about what they're putting their money into. It's so sad.
It is because,
well, it puts the whole industry under scrutiny. It's like, well, what's going on with this whole real estate thing, right?
Yeah.
And I think there's good opportunities in real estate, but when you look at this, it's like, well, you know, even if you have the same model as them, but you do it differently, well, now, it looks bad, right?
Yeah. Yeah, and for the people who've invested, like especially the promissory notes, right? The general consensus is that money's gone.
Yeah. Yeah.
Like they're not getting it back.
Yeah.
That really sucks.
That's a lesson.
Yeah, if you're just like sort of average Joe Schmo, and you've built up some money and you've got maybe $100,000 that you invested in these promissory notes, and first time came back great, second time, okay, let's do it again. Now it's just boom, gone. Yeah. Like, wow. Right. And these are not all like young, foolhardy people. There's a lot of older clients who've been dealing with this company for years.
Yeah. And it works both ways, right? Like real estate can really serve to boost your finances.
Yep.
Because you're dealing with leverage on big numbers when there's growth and when you do things properly, you can really transform your financial future for the better.
Yeah.
But if you make unsound decisions and you're seeking, you know, short-term gains and things go the wrong way, right? Like the rates go up, the market comes down, things get tight, contractors aren't paid, fines happen, right? Like then you can lose quite big as well. So when you get into this space, I think it's really important to think through the risks on both sides and make a really wise decision, right?
Well, and I mean, in, you know, our age of social media and, you know, everybody's like trying to get an edge and do marketing. We're talking about this, right?
Yeah.
Use social media for marketing and do all this marketing programs. Like you got to pay attention, right? Because the flashy...
Well, like if the guy's on a boat in a yacht down south or whatever.
Well, but people gravitate towards that, right? Yeah. Like, oh, he's successful. I want to be around that person.
Yeah. So I want to follow him.
Yeah, I don't. But again, that's symptoms of our short-term thinking, right? Yeah. So generally, I mean, something's all the rage. You really got to take a second look back at it and like,
So that's what I did with Bitcoin, because Bitcoin was all the rage, and I was like, Yeah. And then I started reading books, and I'm like, oh. That's interesting.
Yeah, you do. And I think a lot of people are like that, right? Like, oh, dismiss. It's still here. Yeah. Read about it. But I mean, we've talked about, and I mean, this isn't so entertaining, but we've talked about the reasons for getting into real estate, for doing real estate investing.
And they're still valid.
Yeah, they're still valid.
Yeah,
there's fundamentals.
Still opportunities too.
Yeah.
It's just the opportunities when the rates are spiking up and there's a lot of fear and uncertainty in the market. Yeah, the opportunities are different. Like it becomes longer term too, right?
Yep.
You're not going to get the gains that we did 5 years ago or 3 years ago, right? When you bought, everyone was successful, right? Yeah. Well, now you're going to wait longer, essentially, right? Which is not a bad thing. It's just, get in and wait.
Exactly. Temper your.
But do you want to pivot to something else? I think.
So that's it. Well, I just thought, a lot of people may have heard of this, and
I think there's other stories as well.
Provide a little bit of color. Yeah, I'm sure there are. This was like the highest profile one. So
and it's local for us. That's interesting because I do know personally people who have invested, and also people who are like worked with them before. And
Well, when you have that many that many houses, you're going to impact a lot
like
of
1% of Ontario.
What was something like 1 or 2% of the housing stock in Sault Ste. Marie?
Ooh.
right? Which is, it's a lot. It's a lot. So do your homework, people. Okay, what did you want to pivot
we're talking
to there,
about,
Brent?
I think you mentioned the CBO debt projections.
Yeah.
And
Talk about interesting.
well, interesting.
What's the CBO, Brent?
Congressional Budget Office.
Oh, okay.
Now, don't ask me what that is.
I thought maybe it was like the chili bake-off.
Yeah.
That would be interesting.
The nonpartisan analysis for the U.S. Congress.
Yeah, it's a governmental organization that's supposed to not be partisan. I think they do a pretty good job of actually not being aligned to one party or the other. They just put out their info, and it just looks worse and worse every time.
Yeah, talk about two eyebrows raised. Well, when a government organization puts forward a projection, I don't know, I always raise my eyebrows because I'm like, okay, are they going to be conservative? Are they going to be realistic? Is there some data that's skewed here?
Yeah.
And then when they project something that's like insane, you think, okay, are they actually realistic? Or are they still like, are they not taking into account certain things? You see their projection.
Let me share your screen here.
You got my screen there. So this is federal debt held by the public, 1900 to 2053. So they're making a projection all the way to 2053.
Yep.
Right now we're at like World War II levels, and they're projecting just this wall of debt. So yeah, for people who aren't looking at it, by 2053, it's basically doubling, and that's a projection from a government organization, right?
Yeah, and that's a conservative. Let me flip to mine for a second. A conservative estimate, because I mentioned this earlier, right? Again, if you're not watching, you don't see this, but effective federal funds rate, actual 2023, 5.05%, 2024, 5.1%, and then it starts to decline till you get to 2027, where they say, okay, it's going to be at 2.9%.
Yeah.
And then real GDP growth of 2.2% annually from 25 to 28. So
are those optimistic numbers?
I think so, right?
But what you're saying is they're projecting that the rates will come down over the next 10 years.
Yep. To around 3%.
But what if the rates don't come down?
And what if GDP doesn't sit at 2.2%?
So they're making some assumptions there.
Yep.
And then they're also assuming in these projections that there will not be any correction or crisis or anything in the market that will be like a COVID or a war or anything, right?
Yeah.
Like a great financial crisis in the next, 30 years. And we just said off the top, like every time there's a crisis, it's more violent and, there's more frequency to them now.
Yeah.
So this is
worse and worse.
But it's still.
But why are we talking about this, Brent? Like, what do we care about the U.S. Public debt? Did I stump you?
Well, we're not U.S. citizens, so I guess it doesn't really matter that much.
No. Well, I mean, I think you pointed out, maybe somebody else had pointed it out, that when you look at U.S. debt predictions, and then you look at Canada, like, we're better. We're better at making debt, right?
We're better at printing money.
Yeah. Than even the U.S. So our predictions would be even worse.
Yeah. Well, okay. So what this points to for me is that the whole system that we have is operated on debt. So if we can't print, or if we don't print more money, we can't pay for our debt. And that's why that number you mentioned about the interest rates, right? That is very important, because if the debt is high, right, and it's like the highest, it's getting to the point where it's the highest in history. So if the debt's really high and the interest rates are high, we're going to need more money to pay for that. So they have to make more money, which just means more debt. And it's like this cycle, right, of this. And that's in my opinion, kind of why this curve starts to go up. And they just have an exponential curve going.
Well, they realize.
Yeah, they realize, and they're not hiding it, right?
Yeah.
And that's just, and what that means for the average person is what's really important, right? Like, if there is more money in the system, the money you have is worth less.
So if they double that in 30 years, if I have $100 now, that's really worth $50 in 30 years.
Yeah.
At good, conservative estimates.
Yeah.
So yeah, so I think this relates back to what we always talk about, right? Is like you got to have assets,
Yeah.
and because if you don't, you are gonna lose purchasing power. And then yeah, what does that mean to you? Do your wages increase at that rate over the next 30 years? Probably not, because they just haven't for the last 30. Wages haven't kept up to inflation.
Yeah.
So you got to do something different if you want to take care of yourself and take care of your family. And like that sucks.
Yeah,
for the average person. The average person.
Yeah, what that actually means to the average person is that your standard of living is just eroded at this increasing rate over time.
Yes.
So you think you're good at where you are now, while in 10 years and 20 and 30 years, your purchasing power is going to decline. Your standard of living is going to have to decline. And I think what happens to society when everyone's standard of living declines is you get less services, less quality products. You get more social unrest. You get people who aren't happy, right?
Yeah.
My standard of living is declining. Everyone's standard of living is declining. Everyone's kind of frustrated about that.
More crime.
Right? Yeah, more crime, more dissatisfaction, and more,
and
depression, anxiety. Like all of these things are just snowballing.
All the things that we are seeing right now.
Yeah.
And this is only predicted. And I mean, we're looking at the economy and kind of projecting that onto everything else. Yeah. But yeah, it has such an effect, right? Because if
you can't pay the bills, that affects your mental
that affects
state,
everything.
And your sleep and your health, and your choices, right? If you can plan for the future and you think long term, then you'll have a bit of stability, right? You'll be able to afford food, and then you don't have to think about food. Okay, well now I can think about the next thing, right? But if all of a sudden you're in a pinch, you can't pay the bills, like what are you going to resort to, right?
Yeah.
Outlets like whatever vices in this world, right? Look for short-term pleasure. Like, can I just get something for today? Right?
Yeah.
Yeah. And so I don't know. When I look at this graph, that's kind of what I see for the future. If they're making this projection saying, well, this is what's going to happen, that's what I think is going to lead to more of that.
Yeah. How could it not, right?
Yeah.
So one argument that people will make is that, hold on, you're not talking about technology. And Jeff Booth talks about this in The Price of Tomorrow. The benefits that technology will have. And, AI is sort of the biggest
technology makes everything easier.
And cheaper.
Do more, faster, yeah.
Yeah, so I mean, if you look at television sets, for example, right, go back 10 years and then go back 20 years, right? It's laughable how small TVs were 20 years ago, even 10 years ago, as compared to now, right? Yeah. They only get bigger and less expensive per pixel or square inch, however you want to.
Yeah, better quality.
Better quality. Yeah, picture gets better, all that stuff. So that's, people will point to that and say, look, technology is deflationary. And it is. But is it enough to make up for
all the money that's being printed?
The inflation?
Yeah.
Is that deflationary effect
this
enough?
Is insane. So the government is essentially just stealing all the productivity gains of technology.
Pretty much.
I don't know if I have to say that slower, but the government or the central banks, through creating new money, are stealing the benefits that people otherwise would have seen from new technology being developed to make our lives better.
Yeah.
So everybody out there who's running a business trying to make products and services better and technology develop, right? All those efforts are working, but all the gains from those efforts in terms of what we would have had, a higher standard of living, we would have had better, everything would have been easier, better, faster, stronger, whatever, right?
Yeah.
That's being stolen by printing new money.
Yeah. So look at the Victorian age, right? When we had a lot of advances in technology, and really that was when the vast majority of people were pulled out of poverty.
Yeah. Because
prior to that, you had, more or less a feudal system where you had 0.5% of people were wealthy and everybody else was poor. There was no middle class.
Yeah.
Middle class was kind of created at this time. And the people, at least in the Western world, who were poor, were much less poor. Went from abject poverty to, relative poverty. But the government wasn't able at that point to increase the money supply. So that if that deflationary effect of technology, right, when you had like steam engines and the telegraph, I mean, this is over a span of time, but you think of railroads and all
that
these things.
Those things on a sound money standard transform their standard of living in their life.
Yeah. So and so access to better forms of energy was like a huge part of that, right?
Yeah.
I've talked about energy before, but
and now
you couldn't counteract
as
that.
The enemies of development of energy and
Look at oil prices. Look at the price of energy. So all these deflationary effects that happened then, like it had the effect of raising the standard of living for everyone in the world, and I mean not absolutely everybody in the world, but relatively if you were to look at like people living on $1 a day versus whatever it is now, much smaller percentage. But yeah, you're right. The government is essentially stealing our productivity gains by unsound monetary policy.
Yeah,
and fiscal policy.
So yeah, then when you look at the projection on this graph and you see them blatantly just saying we're going to print more, and it's going to be like, it doesn't look like there's anything they can do in their power to decrease the debt, right?
Yeah.
They could tax you more. Like, how can they get rid of this debt? They can tax more.
Yeah, I don't think that's the answer.
Decrease spending.
Yeah.
Or decrease the rates that they charge for interest so that, they don't snowball it into a bigger amount.
Yeah, I don't think there is really a solution.
No.
I think it's just we're in this cycle, and
so now that we know
conclusion.
that, what do we do with that information? Right? Like, you feel like hearing that, it's like, oh shoot, I'm in for 30 years of like eroded standard of living, my cash losing value, society deteriorating to the point where like everybody's standard of living is lower and it's not a nice place to live. What can I do about that? Right? Like, I'm handcuffed to the system.
Well, so we've already seen the first iteration of that, right? If you look at that graph, you can see, big bump here. And again, if you're not watching, you don't see this, but just around World War.
Bump.
Yeah. So you're just looking at federal debt held by the public.
That's a technical
in the
word.
U.S. What's that?
That's a technical word. A bump.
A bump. Yes.
Spike.
If we're too technical for you, please email into the show and we'll try to dumb it down. So a big bump, right? Over 100% of debt to GDP in the 40s. That was World War II, right? So big difference there is that this was a growing economy. We don't have the same kind of growth in the economy. There's not people, there's people immigrating to the States, but it's a different kind of growth, right?
Yeah.
Totally different immigration scenario. Anyway, so that interest rates or inflation ran very hot for a while and cut that debt right down. And you get to, the 70s, 1971 gold standard. But anyways, we pop over here to mid-2000s, and then you see a big bump, right? 2009, I'm guessing that is the great financial crisis.
Yeah.
Huge bump in debt. And then, if you look back to standards of living and everything else from that time to now, you can see everybody's standard of living has decreased. Almost everybody.
Yeah.
Right? Except for asset holders. Theirs has gotten better. We've talked about this, not a new concept, nor did we invent it, but the destruction of the middle class.
Yeah.
The middle class is getting hammered, and everybody's going to get hammered soon,
not
unless you hold assets.
Not like drunk, but...
Well, maybe that's the only answer, right? Okay. To deal with the problems.
Well, yeah, just to illustrate a bit how much of a snowball it is, the interest payments are a big contributor to the debt, right?
Yeah.
So what did they say? Net interest payments will climb to 3.1% of gross domestic product. So of all the money that the U.S. generates, 3.1% is net interest payments.
But that's not money that the government generates either. That's the whole economy.
The entire U.S. economy.
Yeah, it's not 3% of government payments, because people will look at that and be like, oh, it's 3%. No, that's the whole economy. And the government does not. They get a piece of that.
Yeah, they can tax a little bit.
Yeah.
Yeah. So 3.1% of GDP, that's the highest level in records going back to the 1940s. And then they're projecting, the CBO is projecting that it's going to go on to hit 3.9 in 2034. So it's going to go up in the next couple of years.
Like almost a quarter.
Yeah.
Almost 25%.
Yeah. So they're projecting to go up as a percentage of GDP over the next 10 years, right?
Yeah.
And like we said, like net interest costs. So like it says here, net interest costs are a major contributor to the deficit, and their growth is equal to about 3/4 of the increase in the deficit from 2024 to 2024 to 2034. So, oh man, that just means it's snowballing at a faster and faster rate, right?
Yeah. Yeah. And I mean, all the predictions they have are GDP growth going down. I mean, so yeah, you can just look up Congressional Budget Office if you're interested in this sort of thing, and kind of geek out on it, right? One thing I'll just share quickly. I'm sure people are falling asleep now, but one more chart of outlays by category. So what they're actually spending the money on. So net interest, you said, 3.9% of GDP. Discretionary will drop, so that's interesting. Okay. Mandatory is going to slowly increase, though, to 15%, 15.1%. And so that's interesting because mandatory spending is like Social Security and all these other things. So you see, so they can't really not pay those without causing massive problems.
Yeah.
Right? Like cut your Social Security payments or your old age payments, right? Like that's going to be pain for a lot of people who can't take it. So, very interesting. Very interesting. And I just want to go back to talking about destruction of the middle class, right? So the reason I think that is happening is because the biggest asset, not technically an asset, but that the middle class has is income, right? We're talking about people who are, educated, quote unquote, who make a good, that's their thing, is they can produce a lot of income every year, right? They may not have a lot of hard assets like real estate or Bitcoin or gold or whatever, but they're able to maintain a good lifestyle and they're getting money so I'm thinking of
hardworking, did all the right things.
Yeah, did the education, making good money, meeting their obligations, not having tons of debt, all this stuff, right? And, at the high end, you would see like doctors and lawyers. So you're talking about maybe a couple $100,000 a year. And then at the lower end, I don't know where that would be. But it's not just like, because people think like, oh, if you're a doctor or a lawyer, you got it made. Well, that just means you're making a lot of income every year.
And paying a lot of taxes.
And you're going to pay a lot of taxes. But what happens is, as we're talking about inflation, if your income is being cut in half, essentially over the next 30 years, wow, what's the point, right?
Yeah, why am I working so hard?
It just means you're going to become poor slower than everybody else.
Yeah.
So if that's your primary thing is your stream of income.
And where is this all going? Where is the money going to? It's just funding debt payments. How sad is that? It's not even going to infrastructure. It's not like in 30 years, you're not going to be able to buy anything. But by the way, we're going to have all this infrastructure and beautiful services. No, we just paid it for the debt.
Yeah,
for all of our past sins. Good luck.
Well, it's a pretty rosy picture, Brent.
Yeah, that's impressive.
So I guess, our conclusion again is that you need to have assets. Right? If you be on one side of the debt or the other.
It's a prudent thing to do, to consider. Once you know this and you know these projections, and they're not hiding it, then if that's the way the system works and the government is doing it on purpose to benefit from it themselves, right? They're printing money to paper over their debts. And if we're asset holders, we're getting loans on assets that are going up in value and getting paid down by other people. That is a way to kind of play what they're doing the same way, right? Just mimic what they're doing and follow the playbook, right?
Yeah.
Then that curve doesn't look as painful. But the sad part is it's at the expense. I don't know. I keep wrestling with this. It's at the expense of those who save in the currency.
Yeah, I guess. But if you know this, then stop it.
Yeah, stop it.
Just stop it. Well, I mean, I don't know, if you're spending, I don't know, if you smoke 5 packs a day, maybe I got to say to you, Brent, stop it.
Yeah, stop doing that.
Either stop smoking or cut down to half a pack or something, right? Because it's not good for you.
Yeah.
And it's the same thing, right? If you're making money, that's great. But if you're saving it in cash, stop it.
Yeah.
It's bad for you.
Yeah. Well, the other thing too, job numbers. So employment is up.
Oh, yeah. Employment's up. Yeah, that's a famous one.
But what's the narrative there? So employment is up, and that's good because everybody's working and the economy's booming.
Yeah, more people are working. Hey, great. Right? But when you look at the total number of people in the labor force, I don't have the numbers here, but I don't think that's increasing so much.
The number of people working.
Yeah. So if jobs are up, but the number of people working jobs isn't up, what does that tell you? It tells you people are working more jobs. And I mean, how many people just work one job?
Welcome to What's Behind the Curtain with Mark.
How many people, especially young people, just have one job?
Yeah.
It seems, and this is anecdotal, but it seems like every young person I've talked to recently has, like, they got a job, right?
And a side gig.
And then a side gig or another job and a side gig.
Yeah.
Right? So that's not good either, right? If people can't just work a job and pay their bills.
Yeah. Well, mattress sales are way down. So there's a little bit of a correspondence there. Nobody's sleeping anymore. They're just working.
Yeah, couch sales are up. Yeah, everybody's sleeping on somebody's couch.
I think we should start a couch business.
Yeah, I know. We've talked about it.
Futons.
Futons?
Yeah.
All right. Well, I don't know. Is that enough cheer for one episode, Brent?
I think so.
I think so too. A little bit of an update for you, everybody. Yeah, it's not rosy, but I mean, there's answers, there's solutions, right? We've talked about that, and assets is one of them.
Yeah. So steward your wealth wisely, I guess.
Yeah, I think that's the whatever you're doing, be wise about it. So yeah, okay, we're gonna end off on a whimper. Thanks for listening, folks, and until next time,
steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
And if you like my voice better, click share.
If you like both, give us a 5-star rating.
To interact with the show, feel free to reach out at hello@twostewards.ca.
We will see you in the next episode. In the meantime, steward your wealth wisely.